We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Micheal Oliver from Momentum Structural Analysis. How are you today, Micheal?
I'm doing fine, Tom.
Great to have you back. And, we always have a good discussion on charts here. And I guess today is no exception, right?
Right. No exception. It's
So-
what we do.
I wanted to start by talking a little bit about gold and inflation. You sent me this report here recently, and I've mentioned on the show many times talking about, is gold a real hedge against inflation? And I think this is a great way to look at it over the longer term. So why don't you tell us why you put this report together in this way and what we're looking at here?
Well, the top chart that you just showed, BCOM, is the price of the Bloomberg Commodity Index monthly closes going back 23 years to 1999. Okay. And it's just simple price chart. And you can see there was a big, powerful move there between 1999 and 2008. Okay. Now, you look below it, you'll see gold, same time period there, 1999 through the present. And what the point of this report is to compare gold with the commodities, because so many people are making the statement and assumption right now that, gee, gold's not doing well because we've got this commodity price inflation, gold's not going up. Well, the correlation between gold and commodities specifically is not good. Okay?
Yeah, especially when you look at these two charts against each other.
Yeah, just to hold it right there where you can see both at once. See, during that period from 1999, gold made a low in the $250 area, okay? It surged up to 850, then had a pullback, and then went all the way up to 1900. It doesn't quite show it there because the monthly close is above 1800, but it did get to 1900. Okay, now look at the same time from 1999 to 2008, commodities were going up too. So it seems to be coincident. But look what happened in 2008. Commodities collapsed along with stocks in 2009. Look what gold did during that period. There was a little dip there. You went from high monthly close in the 900s to a low monthly close about 700, and then you blew the lid off gold. Commodities didn't explode then. They bounced halfway back to the high, while gold doubled. Okay? So gold basically was in a constant bull trend for a dozen years, whereas commodities were in a bull trend for about 7 or 8 of those years, and then went into a down move, a bear market, arguably. Mm-hmm. Made a secondary high in 2011 when gold was making all-time new highs. And then commodities really collapsed. They went from, a high that was actually above 180 on the Bloomberg, all the way down to 60 in late 2020. Okay, now look at gold. It made its peak there in 2011 in the 1900s, actually, and went down to a low just above 1,000 in late 2015. Mm-hmm. Then gold shot up and never went back to its low again. That 2015 low was left alone. It bounced off of it, went up into the 1300s, built a trading range well off the low. Meanwhile, commodities continuing to erode lower. And then gold doubled. So between the 2015 bear low, which price was 1,050, you went up to an intra-month high of 2070 in summer of 2020. Meaning gold doubled while commodities were making continually new lows. Okay, so again, the correlation between the commodity complex, that category, and gold is not very good. Mm-hmm. Even over the span of that 4 or 5 years, gold doubled and commodities went down. Then finally, commodities, and we put out a report in October of 2020. And the headline of the report was Commodity Explosion Coming, mm-hmm. with the word emphasis on explosion. Well, they did. They more than doubled between the late 2020 and earlier this year. Okay. Meanwhile, during that time, gold was going sideways, congesting. So people look at that and think, well, gee, gold's not performing well. Yes, it is. It already doubled. Bloomberg caught up to gold finally and doubled off its low. But a year and a half after gold had already peaked before commodities turned up.
Mhm.
So again, the point of this report is to say, this is not the best way to define inflation. Commodity price increases is one only aspect of what inflation can do.
Mhm.
There's also times when monetary money supply is increasing rapidly, when they're running QEs and they're doing all their other games, where the money doesn't flow into commodities, it flows into stock market or other asset categories like real estate. So from 2009 low in the stock market to 2021, the stock market went up sevenfold over a dozen years as measured by the S&P, 16-fold as measured by the NASDAQ 100. It's the biggest stock market bubble in U.S. history. So the inflation that we had between 2009 and 2021, and we had a lot of it, and we know all the excuses and names they attached to it, went into the stock market. Now, major asset managers around the world, and there's a lot of them who aren't gold bugs, but who see reality, have made statements to the effect like Ray Dalio did about 6-9 months ago. He says, listen, quit looking at the price of your stock, implicitly stating that it's not so meaningful. Instead, look at the underlying degradation in the value of your money.
Mm-hmm.
Okay. In other words, the central banks are destroying your money unit, and it's reflecting in your stocks with higher prices, but it doesn't mean much because your money unit's degrading. So that's an inherent bias favoring gold. And asset managers like him, and I can't specifically talk about their portfolios because I don't know it, but I can guess solidly that there's a lot of major asset managers out there, global type, who are shifting emphasis from what they see as a risky asset category, namely the U.S. stock market, into other, what they perceive to be safer asset categories, namely gold and related. And that's perhaps an explanation of what? Gold, look at that chart on the top. This is arithmetic scale now, so it's not ratio scaled. You've been in a 2-year range now, and you've come up off that low again. You pushed back up to 1,800 almost this week. But gold's been in a 2-year range with 3 drops in gold that have dropped below 1,700 since March of 2021. Yeah, let's see. Scroll a little further. The dollar, we'll go back to that. Yeah.
This chart shows it perfectly.
Yeah, that's okay. But the point being that who keeps buying gold under 1,700 relentlessly? They did it in March of 2021. They did it briefly in August of 2021, and they did it again a month ago when we dropped down to 1678. Mm-hmm. It gobbled it up again. We traded back up to 1790 almost this week. So who is buying gold relentlessly down there, unafraid of all the arguments like, well, gold isn't reflecting commodity inflation? They see beyond that. They're looking at something else. Mm-hmm. That something else is M2 money supply. And I think you've got a chart of that comparing gold. There you go. Yeah, the top chart, you want a relationship of gold to something else. Well, here it is. Now, admittedly, gold can drop in the context of this, but that arrow on the bottom left to the upper right on both charts shows where in mid-1970s, when gold first traded on the COMEX, gold has gone from a low at $103 in the summer of 1976, to over 2,000. It's had a 20-fold increase in price, basically, okay? Mm-hmm. Money supply, M2, has gone up, a bit more than 20-fold increase in price over the same span of time. So gold is reflected with a 20-fold increase in price, the decline in the value or the quantity of dollars. It's been a good hedge against monetary degradation. Whereas that Bloomberg chart we showed previously, you don't have to go back to it, clearly hasn't. Mm-hmm. It's way below any 20-fold increase. In fact, it's at prices we traded multiple times laterally in the last 20 years. So gold is a good offset to monetary degradation, period. And there's a lot of major asset managers who realize that and who don't buy into the argument that the Fed is making that we're going to tighten and tighten. They know better. They know what's going on. They can see the severe drop that we've had so far this year, not just in the stock category, but in things like high yield corporate debt, municipal bonds, and treasury bonds. And what does it mean? It means, well, that can't keep going on because those assets, if they continue to decline, and we argue they will, especially the stock market, the Fed will have to come to their defense again. Meaning there's a point here probably very soon where they're going to have to stop and reverse. And we're not the only ones saying that. Mm-hmm. We know what the Fed is created for. It's to ultimately be the backer of government debt. Because taxes don't pay for government budget. Never have. And they're going to need it because the purchasers of U.S. Treasury bonds and municipal bonds and corporate bonds are going to be shaken, or are already being shaken. So the Fed is going to have to come to the rescue yet again. And frankly, they're repositioning to a tight policy, which, by the way, the ECB has waffled around, and the Bank of Japan has not proceeded in that direction. That policy change by the Fed has helped prick the biggest stock market bubble in U.S. history. And as far as we're concerned, the stock market has made its major top, and it's engaged in a major bear market. We're now enjoying what we defined several weeks ago as a counter trend rally that likely would take the S&P from 3,800 level up to over 4,100, which is where we are right now. We don't trust it beyond here. We think once this rally is over and we resume the downside, that's where the real fear is going to hit investors, the muni bond market, the high yield corporate debt market, and the Fed. And that's what gold, I think, knows. That ultimately the game won't continue to play as it's been playing. And that's why gold is in this quiet trading range. In fact, if you look at that log scale chart that we showed a minute ago, that one there, that little range that we've been in since 2020 high, when we get up over 2,000, is the narrowest percent range gold has been stuck in for any 2-year period on this chart practically, okay? And it's doing what? It's hovering on either side of the bull market peak of 2011. Either it's above and below it, but it's being accumulated. And it's not breaking down. So the people that think this market is collapsing, this is not 1980 on the left side of the chart, nor is it 2011, 12, and 13 when it dropped. It's very quiet up here. It's the narrowest little range we've seen. Now, the green arrows, all they show is the major ratio up legs since gold was legalized. Both of them are equal distant percent scale advances. And if we happen to do it again, in other words, simply replicate those two prior bull markets, then it projects somewhere around 8,000. Are we going there tomorrow? No, of course not. But don't be shocked if that's where we're going. And frankly, it won't be anything special. It'll merely be a replication of the two prior bull markets. And frankly, given the fundamental background that is developed now, namely what we define as the breaking of the largest stock market bubble in U.S. history, the likelihood of this thing going beyond that due to the background factors, namely a panicked Fed at some point, is probably pretty good, that it won't simply replicate those prior bull markets. But right now, we're in this little range, and what our job at MSA is to try to define when we're convinced that gold is going to turn up off of the bottom of this range, which it's already done. It's already rallied $100 off the bottom of the range over the last couple of weeks. When it's sincerely going to turn and likely go through the high of that range. And that's what we monitor day by day and week by week. Mm-hmm. Some of these other charts you've got show some of that.
Yeah, I'd like to just bounce back to this chart here. There's a couple points I want to touch on with you, Micheal. You know, this really shows the importance of looking at the charts and, you know, just analyzing the data over different timelines, right? We have to be specific when we're thinking and speaking about very specific timelines. So, you know, over this span, you can clearly see that gold has made up for or accounted for that growth in money supply or that growth in inflation. Mm-hmm. Whereas if you take a specific time from, let's say, 2011 to 2015, yeah, absolutely not. It fell in that time. So it's just, I think it's an important point to reinforce when we're talking about, or when we're making statements that, you know, gold is or is not an inflation hedge. Well, I think it always depends on the timeline that you're talking about, right?
Yeah, you know, gold's been around for a couple thousand years. It's it's the oldest market on the planet. Okay, And so it does its thing, and it does it glacially, but it does it. There's no other asset in the world you can lay on top of that M2 chart and reflect that. Okay, so it protects the value of your assets. And there's times when it protects it overly, meaning it catches up to any lags it may have had to the money supply growth. It catches up to it and probably overshoots it. So, it could just very well be, as we showed in the log scale chart, that if you come up out of this range again, you may overshoot it again and run this chart up to 8,000. This is the arithmetic scale chart here. But yes, gold does undershoot the money supply growth and then overshoot it, but over the span of time, it maintains its value in relation to the degradation of the money unit. And this would be true with the euro or the yen or any other currency it's measured against. We're concerned about the dollar, of course.
And we'll get to the dollar chart here, because that's very pertinent, obviously, to the price of gold. But the only other point I want to touch on here with you, Micheal, is everybody worries about what's going to happen to gold in a real bear market when margin calls happen, when there's actual panic and blood in the streets. So when we were talking about that example of 2008, you saw this big drawdown in commodities, and as you said it here, we saw this little dip in gold, but gold recovered and made those new highs. So is that the as you see the typical behavior of gold being in some ways less volatile and usually being the first to reflect and rebound from a major crash like that?
Yeah. And first off, U.S. stock market bear markets, only one of them ever began with the crash. That's 29. And even after the 29 crash, you rallied halfway back to the price high of the summer of 29. And then you went down to the summer of 1932 relentlessly, but without a crash. You went down in arm wrestling layered manner. It's full of rallies that no doubt tease people. Most bear markets in the U.S. stock market, go back to the 2000 top, the .com, for example. I don't have the chart here, but if you go back and examine that one, or go back and examine the 2007 top and the 2008 decline, you didn't get a crash type moment in the stock market in the 2000 to 2002 bear market during the whole thing. What's a crash? Crash is usually 35% in 3 weeks. Okay. It happened in 87 crash. It happened in the 29 crash. It happened in March of 2020. But both the 87 crash turned around and made new highs. So it didn't lead to a bear market. 2, the crash in March of 2020 did not lead to a bear market. It led to new highs. Fed came in, and people still put the money back in the stock market at that point. They're not so inclined now. But bear markets usually unfold in arm wrestling manner. So the stock market, even if it's the biggest bubble in stock market history, could take a couple years to spend itself on the downside with all kinds of consequences in the way without ever engaging margin call situation like we had in March of 2020. That doesn't have to occur. Now, if you look at that little dip you got your arrow pointed at almost there in 2009 in gold, actually that drop was in October of 2008 and it involved about 3 weeks. So here we see monthly closes, but really most of that was in 3 weeks during October of 2008. Coincident with that 30-something% drop in gold that occurred, well, it went from the mid-900s in early October to 680 at its low in October 2008. Okay. So what's that? 200 and some odd dollars. So it's a pretty good percent drop when you're coming from the 900s. But we were back to the highs by early 2009. Stock market continued down through March of 2009. So when that gold turned up from that low after the 2008 drop, it relentlessly went up, though the stock market continued down. And gold continued to outperform stocks on a ratio basis from that 2008 low in stocks through 2011. It continued to hands down beat the S&P. Finally, at the 2011 peak, and when gold finally started collapsing in 12 and 13, Gold divorced itself entirely from the stock markets. Gold collapsed without any drop in the stock market. The stock market continued up during that time. So there isn't necessarily a good relation between the S&P and gold. So people were fearful if the S&P is going down like you argued, then gold will go down too. No, not necessarily. And we think that what we've seen over the last 2 years is already the effort by gold to get a downside move going. Instead, all they've been able to do is generate a trading range. And frankly, when you look at it on the ratio scale chart, it's one of the narrowest ranges in 50-year history of gold. Mm-hmm. So there have been 3 efforts to collapse gold, and we made the 3rd one recently. And frankly, we think probably that was it. Now the only issue is a definitive sign that we're coming up off that low for good. We're not going back to that low again. We're going to go back up, get into the 1800s, et cetera, et cetera. And there'll be a point at which we think probably within a few weeks we'll be able to pound the table on that issue. Mm-hmm. There's a lot of evidence out there that that's going to occur. But we think gold has had its chance to try to break down with the stock market. And at the low this year, stock market was down what? 20% in the S&P and about 30% in the NASDAQ 100. The lowest gold's been this year in relation to where it closed last year is down about 6% on the year, 7% on the year. Okay. Now gold at this week's high was down about 2% on the year compared to the S&P, which has had a nice rally, but still down seriously on the year, as is NASDAQ. So gold is an asset category if you're a portfolio manager. Yeah, gold's down off of its high of March, but relative year to year, it's trading down single-digit percents on the year. So it's holding its value relative to most of these acceptable assets that are in portfolios. So it's a good place to be. Gold closed last year, by the way, at 1828. The high this week was close to 1790. So you can do the math. Mm-hmm. Here we have gold. This is up through, let's see, is this through last weekend? I think so. Yeah, this is as of last Friday now. Since then, gold's got up on that daily chart at the top, back up to approaching that 50-day average. Now, we've defined that a lot of people look at moving averages by overlaying the average on a price chart. That's quite often not helpful. I mean, you'll notice back in early 2022, a couple times gold dropped below that average and didn't mean anything. Okay, it broke below it a couple times and still took off, made the high in March. Now, since April of this year, gold has been under the 50-day average, and it's had a couple rallies. One was in late April. You could see it on the momentum chart where you tried to rally up to the 0 line. The second wave down after that occurred, you another rally up, and this was in June, mid-June, you rallied up toward the 50-day average and failed again. And again, yesterday and the day before, we approached the 0 line again, meaning there is really what we call a momentum structure there. So while you don't have a flat structure on the price chart that you can define, momentum has a flat ceiling above it that has been tested and tested. You ever close back above the 50-day average and you'll blow through that red line structure on momentum, completing a W bottom. Now, the other feature on this chart is we've noted with a -1, a -2, and a -3. There have been 3 waves of momentum decline, and usually that's all you get in any trend, whether it's long-term or, in this case, intermediate term. The 3rd wave did not confirm the new price lows, which we made our momentum lows back in May at -2. And even though you made after that, you made lower price lows, momentum did not. So you've got 3 waves down, which indicates maturity. You've got a base having been developed, and you've got a clear breakout level at the top end of the base. Says you ever close over the 50-day average? Believe it. It actually means something. Mm-hmm. Of course, that average is dropping day by day, such that by Friday of this week, it's going to be around 1790. So anyway, that's a feature we're watching, one of many.
Mm-hmm. Yeah, it's interesting to look at the momentum and see that breakdown in price isn't matched by the momentum in that wave 3 there. And as we were discussing that, I remember watching getting below that $1,700 mark. I believe it was last week or the week before. And we weren't below that for more than probably 2 hours. And, to your point, it seems like somebody's relentlessly buying, below that $1,700 mark.
Yep. For the third time, which is shown on this chart. But that's interesting because we also keep point and figure charts of gold. It's one price chart feature that I tend to like a lot, that and Japanese candlesticks, far more than normal technical analysis. But a point and figure chart, for example, gold set a double top at 2050 because it went back up to that high in March of this year, which matched the summer high of 2020, also at 2070 price level. So we set a double top on price on a $50 by 3 block reversal point and figure. And again, the chart's not here. In the history of gold, it's never made a top that it's come back up to a second time. In other words, it's never double topped. Anytime it made a peak, it waved goodbye to the peak and congested below the peak, as in the 1980 peak was at 850. You never went back up to 800 again. Mm-hmm. In 2011, the peak was over 1900. When you dropped, you couldn't even get back up to 1800 again. You congested between the 1500s and 1700s before you then collapsed. This time we went back to top tick. That is telling. That set a double top on a $50 by 3 block reversal chart. Now, on the downside, you can't see it on this chart here, but on a 50 by 3, you've dropped to the 1700 level 3 times now. Now, a point and figure guy who's used to only looking at that sort of metric doesn't care about the short-term swings. He only cares when that point and figure changes direction, in this case by $150. 3 upticks, 3 downticks to change direction. And again, it's got 3 lows at 1750. At 1700. If you ever uptick and touch 1850 on gold, you'll put 3 upticks on the board on a point and figure chart, which means you're coming up off of a triple bottom. And usually that is a decisive statement. It's saying, I could have had a triple bottom breakout. I didn't do it. I'm going up. Mm-hmm. That really was support. So just on a price basis, forget our momentum work. You ever touch 1850 again, it's saying, hey, wave goodbye to the 1700 level. I held it a third time. I'm going up. And I've got a triple top breakout pending up there. Anyway, these charts here. This is, again, as of last Friday, these are weekly bars. And again, it didn't confirm either. We're measuring against 3-week average here. You'll see there's also 3 waves. And the third wave didn't get as low as the second wave on momentum. And you also have a flat ceiling. The difference here is we broke through that ceiling this week on this oscillator. So weekly momentum has punched a bar out above that red horizontal you see on the weekly oscillator. Mm-hmm. So this particular momentum indicator has broken out. Now the 50-day hasn't. It's a bit bigger time scale. 3 weeks is only like a 15-day average. But this time scale says, okay, good chance you've seen the low. So we're starting to get evidence that gold, in fact, has put in a low that's credible. So again, we look at various metrics. We want to see enough consensus among them to say, okay, we see enough proof. Right now, this guy says thumbs up. The 50-day still short of the numbers.
So do you start to look at the shorter time frame, and then that kind of adds to the weight of evidence that we have made a low as these, shorter to longer time frames stack
fall
up
into place? Yeah, it's like one domino topples into another. Mm-hmm. The question now is, will this 3-week average breakout, which we just saw this week so far, create enough upside in the next several weeks to in turn push that 50-day oscillator through its structure? And I kind of bet it will, but you can wait for the numbers. There's no reason to guess. So when this 50-day breaks out, the conviction level that we've made the low goes even higher. Mm-hmm. Okay. Right now, we've got weekly momentum evidence that it's turned. This intermediate trend here, 50-day oscillator, is just short of it. Went up and probed that line again this week, near it, just like the prior high in mid-June. Mm-hmm. You ever clear that red line, and it means clearing the dropping 50-day average is shown on the top chart. You clear the 50-day average, and that momentum chart breaks out of a massive base. In fact, the base goes back to April. It's quite a few months of basing there. So our conviction level jumps at that point that gold, in fact, pound the table. You saw the low.
Yeah. Micheal, I remember you and I have spoken before about when you turned bullish. I believe it was in 2015 at some point, right?
That was in February of 2016. Gold made its low in December of 15 at $1,050, at 1,140 plus in February of 2016. So just coming off that low it's to the right there. You see it right there. Just coming off that final low, we got bullish at 1140 plus. Gold could never get back to its bear low. It had rallies and failures and rallies and failures for the next couple of years, but it couldn't get back to its bear low. And then it blew through the ceiling in early 2020 and went from, like $1,300s to $2,070 in a matter of about 6 months. Actually, about 6 months. And now it's congested since. The difference now is that gold was able to go back to its high, especially evident intra-month chart. Going back to its high, we think was a tell. It says, hey, I'm stronger than you think, because no other prior bull market's been able to get back to its high in gold once it peaked. Right. It means probably I haven't peaked.
The reason I wanted to bring that up is because I wanted to ask if you remember how the momentum and breaking of those, intraday moving averages, or those 3 week to 50-day moving averages started to stack up at that point there.
Well, at that point, it was strictly annual momentum pounded the table. In other words, we ran a 3-year average oscillator or a 36-month, and we measured each monthly bar in its relationship to how much above, how much below the 3-year average wasn't. In this case, we used a 36-month average. You'll see, after the bear market had its collapse in 2013 down to about 1,200, it then went down in little staircases to make its final low. So for a whole year there, for 2014 and into 2015, gold went down in little steps, with lower highs and lower lows in that final part of that bear market. When you ran a momentum chart of that, and we don't have it here, it was a flat ceiling. In other words, it looked like that 50-day average oscillator I showed before. In other words, it wasn't a declining pattern. It was a ceiling over your head. And at a price of 1,000, this flat ceiling on the oscillator below. Annual momentum back then, imagine these are monthly bars, had a ceiling just like that, except it had gone up to it 2 and 3 times for a 1.5-year period of time. February 2016, at a price of $1,140, which didn't mean much on price charts back then, it blew through a comparable ceiling. So again, what momentum tells us often is it gives us a different technical picture of a market, whereas price might not have a good structure to break out above, but momentum will quite often develop clear channels, or in this case, flat structures. And even if price doesn't have a comparable structure, when momentum breaks out, and it usually does so before price does, price will follow. So that's why we favor momentum over price, because generally momentum will tell you, 1, hey, you didn't confirm the low, and then 2, I've got a structure to break through, which is not evident on the price chart. So that's why we emphasize momentum. But no, ever since that annual breakout we had in February of 2016, there has been no negation of that. Words not shown here, but the annual momentum chart of gold since then has not had a clear structure to break down through. It has not developed the kind of structure that would indicate bear trend breakage. And therefore, there's been no negation, despite any multiple sell-offs since 2016. None of those sell-offs have broken annual momentum into a negative trend. And it wouldn't shock me if that continued for another couple of years.
So let's move on to silver now. There's a lot to look at. Did you actually want to start with the?
That's good. Yeah.
Silver? Okay.
This is as of Friday again, and these are daily bar chart price, and then the daily bars below in relationship to, in other words, how much below or how much above the 50-day moving average. Okay. Anyway, silver on this 50-day average oscillator had 3 waves, just like gold had on its weekly, and it's 50-day. And the third wave in momentum didn't confirm the new price low. So that's a hint that, hey, I want to turn. And sure enough, last week, middle of last week, silver momentum broke through this 3-point downtrend line. And when it did, it roared. Why? Because momentum broke through something significant. And it ran up to the red line, which is at the zero line, meaning you ran up to the 50-day moving average. And we suspected in the weekend report, this is where this report comes from, as of Friday, that you'd probably have trouble around the 50-day average, around that zero line. And sure enough, you did. We thought maybe you could drop back down even to $19 after going up there. Well, so far we've gone from 2050 down to, I think, a low so far this week at about 1960. So that zero line is now important. So just like with the gold chart, where we showed that there was structure at the 50-day average, there was a zero line on that oscillator. Similarly, there's structure here at the zero line. And we've already overcome the rally high in June on momentum, which stopped at about -1. So we've cleared that hurdle, but we're bumping the zero line now. So both gold and silver now both say, if you can close those markets above their falling 50-day averages, then this intermediate trend chart says, yep, further validation that you've seen the low. Now, we did expect resistance added on the first hit, which we did get this week so far, and you've backed off so far 70, 80, and 90 cents, actually. If you go back through that falling 50-day on silver and gold, pound the table, circle the low, you've probably seen it. And low in silver was in the high 17s.
You and I were speaking before about this weekly spread and the importance of it on silver versus gold here.
Right.
Is that just another form of confirmation of moving up?
First of all, it hasn't broken out yet, but let me explain why this is so important to us. In fact, I'm going to make an outlandish statement. You can throw all your gold silver charts away, and all you have to do is pay attention to these two charts. Why? It's just a fact historically that when you're in a bear trend or an intermediate downtrend in silver and gold in terms of net price trend, or if you're in a net price uptrend in silver and gold, silver's going to beat gold on the upside and silver's going to beat gold on the downside. It's going to perform worse. So you go back here to March of 2020, you'll see that spread chart made a low. The top chart is the spread chart. It shows the weekly closes of silver expressed as a percentage of the price of gold. And at that point, silver was down like at 0.8% of the price of gold. 1 ounce of silver versus an ounce of gold. It surged all during that March 2020 period until the summer high of 2020, when it got up to 1.4%, and went even higher into early 2021. Now, if you go back and look at a silver price chart, don't switch from here, but silver actually made a marginally higher high in March, in early 2021, slightly higher than its summer high in 2020. So the silver spread continued to favor silver until silver finally made its peak, which is in early 2021, when it traded slightly over 30. At that point, silver started to underperform gold, where the spread chart, the black line on the top chart, started to zigzag down. All during that time, what's happened? Silver's gone down and gold's gone down, but silver's gone down more, which is always the case. So the issue now is, when will that top chart, which, by the way, had about a 50% correction, if you look at that black line, it pulled back about halfway to that March 2020 low. Last week, it shot up pretty strong. The spread did, the black line on the top chart. Slightly up above its falling 10-week average, like a 50-day average. Now, the chart below is a momentum chart of the spread. And what it does is it measures where is the spread week to week in relation to that changing 10-week average. And as you can see, the spread chart at the top is zigzag both above and below the 10-week average. So the 10-week average itself has not been important. But you'll notice on the momentum chart that it's crested 3 different times at about 0.5% above the zero line. So you've created a ceiling on the momentum chart that you cannot see on the spread chart. So momentum has set itself a structure that if it can clear that dash line on the momentum chart, momentum is breaking out and it's saying, okay, the correction that's been underway since momentum peaked in summer of 2020 is over. silver is now going to outperform gold. Well, with great confidence, I can say that if this spread chart and its momentum chart, which will break out first, turn up, favoring silver, it's making a statement that, okay, silver's now going to beat gold. And if that's the case, it means we're turning up a net trend on both. The difference being that silver will lead this time. Instead of downside, it's going to lead to the upside. So we think this set of charts is extremely important. And it won't take a heck of a lot of any upticks on the spread chart to cause that momentum to blow through that ceiling. And that ceiling goes back a year and 3 months. So it's an important base. Mm-hmm. So this is an important technical we're looking at. And when that line is crossed, and we'll tell our subscribers when it does, you can again pound the table that, okay, you've seen the low, we're on our way back up.
Just adding to that weight of evidence.
Yeah, we're looking at various things. And this is a pretty decent time scale. It's correctly measured the declining pattern in silver versus gold for the last year and a half. Mm-hmm. And sure enough, what have they done? They've both gone down for the last year and a half. Okay, even though gold went back to its highs briefly, but silver never did. Silver can never get back up to 30. So its continued negative pattern versus gold has continued. And sure enough, so is the net trend of both. But in our opinion, this chart's about to turn. Also notice on the spread chart that the recent lows on that top chart, it dropped down under 1.1%, well below the lows that occurred late last year. Momentum didn't make new low. So again, momentum is non-confirmed the recent weakness in the spread, which is a hint also that, okay, I'm ready to turn. You go back, and pardon the classroom here, go back and look at the spread chart again in the summer of 2020. You got the 1.4% on the spread. Then later on, you got marginally higher in January of 2021, up to over 1.5%. Look at the momentum chart. It didn't make a new high. It non-confirmed that final high in the spread. So it warns you that, I might be making a top. It's doing the exact opposite right now. New spread lows versus early this year. No, it should be versus early last year. Mm-hmm. And momentum is not making new lows. It made its low back in the summer of 2021.
So Michael,
go ahead.
What I was going to say is, when we really see that chart break out, that's when silver, really starts to accelerate to the upside, confirming that move, right? That's when people start jumping in and get really excited and keep buying and buying.
Yeah, right. You'll see the spread chart back in March 2020, it collapsed briefly for 3 or 4 weeks there from February through March of 2020. It went from over 1.1 down to just above 0.8%. But then it quickly knifed up out of there. The momentum chart exploded out of that hole, whereas the spread took a while. It took until early July to make a new high above the 1.2% level. And it shot up to 1.4. But you look at momentum, heck, by May, it was blowing out those highs. Momentum was blowing out those prior highs. So it was much stronger. And of course, we know what happened to silver back then. Silver went from, it was $16 to 30. Mm-hmm. And it was a huge rush, and most of it occurring in July. Well, this spread broke out, and the momentum broke out first, well before the July explosion in silver. So again, this spread shift favoring silver warns you that there was going to be a price shift to the upside in both of them, but silver would beat gold, and sure enough, it did.
Mm-hmm. So let's move on to the dollar, maybe, Michael. There's it's always the measuring stick that we're going against the metals, measuring the metals in. So we've seen all this strength in the dollar. How are you seeing that? The formation of this chart.
Okay. First off, before this chart here only goes back to late 2020. It shows weekly bars of the dollar index. There's a momentum chart below a 10-week average oscillator. But let me comment first. If we took this chart back to 2015, mm-hmm. the end of 2015, the dollar index then was 98.6. Now, look at the left price scale in the dollar index chart. That puts it about in the middle of that price action you've seen over the last year. About in the middle of that, 98.6 is where the dollar index was when gold was at 1,050 low. Okay. So even now we're down to about 105, by the way, this week. This is last week's close. If you measure where we were trading down around 105 the other day. That means that the dollar index was up about 6% above where it was actually trading in December of 2015. So 7 years ago, it's only up 6%. Gold doubled during that time. So on a long-term basis, the dollar index, we're not talking about money supply here. We're just talking about how does the dollar look compared to other trash, okay? In this case, we're talking euro, which is 57% of the dollar index. Mm-hmm. That's the main metric here. It's really not a good index in that regard. But yes, the dollar has surged, but it's been in a range since 2015 of 103.50 on the upside to down around 88, 89 on the downside. So really, a lot of this rally you're seeing on this chart was merely within the range of the prior 7 years. It wasn't until the action back in April of this year that it got up above the top of that range, which had been 103.50, okay? We think we're going to collapse back down into the range. The chart below hints that. This measures each weekly bar in its relation to a 10-week moving average. It's like a 50-day average. And while the price chart has sort of an upward curve, you can't really draw a good trend line on it. You have to draw multiple angled lines. On the momentum chart, you have a parallel channel where if you plot along the bottom and go through weekly closes and weekly intra-week lows, you can see there's like 4 hits along that line. In fact, if we had this week's bar, it's the 5th hit because we hit that red line yesterday. The top of the channel, most of the action is contained by the top of the channel, except for a surge that occurred back in April and May that briefly got above it, tried to accelerate. It failed. And when it failed, it went immediately to channel bottom, held the channel bottom again and the zero line, meaning that when the dollar dropped back in May, June of this year, it fell to the 50-day average, or in this case, a 10-week average on the top chart. So it set the zero line. That number this week is 104.90. Next week, it's 105.32. Well, we've traded to slightly above the 104.90 this week, and we've traded below that 105.32, which would be applicable as the zero line next week. We're arguing that if you ever break the dollar index back below its rising 10-week average, you're going to blow a major structure on momentum that goes all the way back to late 2020, not evident on the price chart. Mm-hmm. You break that structure and the dollar is going to drop sharply. And I think that's going to ambush a lot of people, meaning psychologically, people are all set up for the euro to fall off the page and the dollar is the great reserve currency. Baloney. We think the notion of reserve currency is likely to diminish and go away for good. The world, I think, will evolve into multiple currencies. And likely we'll have a gold-backed currency somewhere in the world soon. Who knows where it'll come from? Probably not here. But we think the notion of a global reserve currency is on its way out the door. And this rally in the dollar does not impress us. It impresses a lot of folks. But when you put it in the context of going back to 2015, you'll see that this rally isn't impressive at all. Mm-hmm. It's coming out of the doldrums and it's going back into the doldrums. Now, if you break the bottom of that momentum chart, we suspect the dollar's got a real good shot of coming down and testing the lows it's made for the last 6-7 years, meaning down under 90. So this could be a major break in the dollar, and I think it'll surprise a lot of people. And it could very well help put some wind at the back of gold.
Yeah, that was going to be my next question there, how that correlation tends to favor gold, if it does.
Well, obviously, since March of this year, the dollar's had a pretty good surge. It's gone from 100 up to 109. Mm-hmm. So it's had a 9% surge from that, where we were in March. That's when gold was 2070. So during that period, yes, gold did weaken while the dollar strengthened. So it's been a pretty good inverse correlation there. But when you go back over time, like I said, you go back to 2015 or the high in 2017 when it was 103.50. Okay, so 5 years ago, the dollar was 103.50. Well, we're trading around 105. What's the big deal? You know, so it's only because of the recent surge that people were impressed. But the context is when you look back at the vista of the dollar going back 40, 50 years, it's no big deal. And if this pattern breaks down, and this is a major trend structure here, goes all the way back, talking late 2020, that's massive.
Mhm.
You break that beast and dollars going down, it'll probably go down sharply initially too, and it'll surprise people. So it'll reverse the headlines we're seeing. The assumptions about dollar strength, which no doubt are reinforcing the gold bears, will suddenly that rug's going to get yanked out from under them. You break that zero line on this chart, and I think it's about to happen.
Micheal, do you think that could be correlated with some type of reversal by the Fed, pulling back some of the rate hikes that we've seen?
It probably will occur before you see any evidence of that, but it may be that what could help the dollar go down is the anticipation of what you just said.
Okay.
There's a lot of economists out there who've already cautioned, and I'm not talking hard money type economists, but soft money type economists who've said, "Hey, Fed, maybe you've gone too far. Maybe you got to think this out. This could create negatives. And so a lot of them have gotten very cautious, and I'm sure Powell's aware of that. And what he's waiting on, of course, is you get him some employment data that he can sink his teeth into that really look bad on that metric, or anticipate something that looks bad, some kind of shift in the job markets that upsets him, because that's their other, their reason to raison d'etre is the unemployment. So if all of a sudden unemployment starts to become an issue or starts to look questionable, and I suspect this thing will break down before we get that evidence. But that's the kind of stuff that this market will probably anticipate. Also, another point, technical, anytime a market overdoes itself, excessive, too much one way, in this case, this trend may be too much, too long this way, certainly very long on the momentum chart. It's overdone itself. And if it's overdone itself one way, often it'll overdo itself the other way. Mm-hmm. That's just the nature of markets.
Right.
And so I think if you break this channel on the momentum chart, I bet you look out over next week, 2, 3, 4 weeks after that, you're going to start to see that evidence that you just mentioned, the kind of stuff that will cause the Fed and Fed anticipators to think, they're going to have to stop.
Micheal, did you want to do maybe oil next? I know we talk a lot about energy here. So are you okay with doing that chart?
Yeah, sure.
Okay. Perfect.
Yeah, this is, we measure crude oil and most of the commodities. We run a monthly report on them. We cover all the commodities. Mm-hmm. And we cover the energy markets quite frequently, but here's our monthly report on crude we just put out the other day. This shows monthly bar chart of crude oil. Since its collapse in 2020, you can see it down around $10. We got bullish on crude oil just above 40. And we did it based on annual momentum, which is not shown here. That's mean measuring it versus its 3-year average, 36-month average. Here we measure it versus a 3-quarter moving average. Now, what's a 3-quarter average? Well, you take 3 groups of 3 months each quarter, and you average them, and you get a 3-quarter average. Changes every quarter. So the number doesn't change. Your moving average you're measuring against doesn't change, but each new quarter it'll change. It's sort of like a 200-day, but it doesn't adjust daily. Well, you can see on the bottom chart that when you surged up off that low in 2020, you got up over the zero line and soon exploded, meaning price got up over the 3-quarter average and then pretty much exploded. Well, that's when it got above 40. So we first turned bullish above 40. And then based on annual momentum, not shown here, we got bullish in the mid-70s for a secondary buy. Mm-hmm. But we've cautioned since then that while it's the headliner, energy sector is, natural gas as well. Among the commodities, it's the headline sector. So are the stocks related to the energy sector. They've been quite exemplary. We were bullish on them at comparably low levels. It's a little late now for an investor to be trying to commit to this sector. We suspect that there is another major upleg in the Bloomberg Commodity Index. And right now we're toiling either side of 120 on the Bloomberg. If you ever close a month out, you can circle this. It's a price-based number. If we close a month out at 132 again, your highest close has been about 131 monthly close. You ever close a month at 132, we're going to launch a new wave up in the Bloomberg. Now, where will the crude oil and the energy sector be in that next explosion in commodities? We suspect they won't be the star. while they're likely to be strong on a ratio basis, a percent gain basis, we don't think that crude oil is especially the greatest place to be.
Mm-hmm.
The risk reward right now is not real good. Whereas if you go long now and it goes up, fine. But when you buy it at 40 and it goes to 130, you've had a pretty huge percent move. Okay. So, if you take your profits here, frankly, that's fine with us. But what we've had so far this quarter, which is this last month, July, you see that bar on the momentum chart drop down to the zero line again. Well, that zero line is 94.49 this quarter. That's where the 3-quarter average is. So all we care about is if crude oil will simply maintain its monthly closes at or above that 94.49. You could trade below, it's fine.
Mm-hmm.
But keep closing out the months at mid 94s, a 95 level, you're fine. Then you're holding momentum support. There's also, it wouldn't surprise us to have another wave up here in crude oil. Mm-hmm. But again, it's after the surge we've had, the ratio move we've had in crude oil, it's not optimally the best place to be. Okay,
but there's no clear structure saying it's going to break down.
No.
Below
in
that,
fact, it wouldn't surprise us if we hold this structure again. I'll tell you what: if you hold this structure again around the 3-quarter average, the zero line, and turn up again, that's when you need to get more cautious in the next downturn, which might be a couple quarters away. So the issue right now is this pullback in natural gas into the 90s is merely corrective. Now, if you close credibly below that 3-quarter average any month during this quarter, and so far in July you didn't, closed out the month at 98.62, so you didn't close below it, even though you traded below it. Mm-hmm. If you continue to hold that zero line, you're holding support. So, there's entirely possible you could have another up wave, and it wouldn't surprise us whatsoever to have one. But again, the risk reward of this next up wave, considering where you're entering on the long side, is not the greatest. Mm-hmm. I'll take a look at natural gas on the next page.
Very volatile.
Yeah. Now, we got bullish on natural gas above $2 back when it made its low just above $1.50 in the summer of 2020. When it shot above its 3-quarter average again, they had a big surge in the low $2 range after the big surge off the lows in August, I think, of 2020. That was our first buy signal. And then using annual momentum, which is not shown here, we got bullish again at 450. Those are our two major buy points. Well, it ran up to 650, then pulled all the way back down to 350. This is late last year. And then shot up to $9, which was our initial working target that we stated last year. So it shot up over 9 and collapsed down into the mid 5s in June. Now, you look at the momentum chart below, which measures each bar in relation to that 3-quarter average, and you can see it's twice come down, now 3 times come down to the zero line and found support there. Mm-hmm. Again, that number for this quarter is $5.47. We're trading $2 above there right now after having returned to top tick, which momentum went back, touched $9 again, which is a good sign. Meaning able to touch the top price tick, so it shows that the air is not so thin up there. Frankly, if natural gas ever matched what oil has done on the prior page and get back to comparable spread valuations versus crude oil, you'd probably see natural gas $12, $15, which wouldn't shock us to see that. But right now, our only concern is we'd like to see natural gas not close a month out credibly below that rising 3-quarter moving average. In this quarter, that's down there. We traded below it and immediately exploded this last month. Exploded from below 547 intra-month up to over 9. So again, it proved to be support around the zero line, around the 3-quarter average. Keep it that way. Mm-hmm. It wouldn't shock us to see natural gas again go up to, $12, $15 or something. Again, we've got a situation now where if you didn't go long at the better levels, like just above 2 and at 450, you're now chasing a market that, while it could have a good move on the upside from here, the ratio now is diminished to where the risk reward is, this sector, again, it states again to us that the energy sector, the component of the commodity complex, has been the leader up to this point in terms of percent gain, but it might not be the best place to be a new investor.
Mhm. And thankfully, this chart isn't as volatile as, let's say, natural gas in Europe or the UK as well.
Oh yeah, well, see, if we ever caught up to them, it'd go off the page. Of course, that's unlikely, but still, we could do a huge spread narrowing between our price and theirs. In which case, you could have a nice further increase in natural gas, and of course, there's an economic wave effect to that, more so than even oil.
Mhm.
Price of gasoline, for example, that is electricity. You know, the Europeans are being choked to death on their natural gas prices, and therefore their energy prices.
Mhm.
And economically speaking, that's likely to bring them down. And as long as natural gas, and we've made this point before, that even if the energy sector doesn't go a lot higher right away and congests, all you need to do to strangle the world in terms of economic downturn, which will further exacerbate the breakage of the stock bubble, is for energy just to hang around up here.
Mhm.
Because these price levels are choking to corporations, to individuals, to families, especially so in Europe. And if we think we're independent of Europe, think again. We're a united world. If they go down to recession, we're going down to recession or worse. So natural gas and crude oil, if they merely hang around up here, is like a noose around the neck.
Well, and if you look at the step back and even look at that from a broader perspective, when we think about the attitude towards oil and gas producers, both in Canada and the US, the political and regulatory environment isn't necessarily supportive. While they have decent prices to be able to, expand exploration, we can't necessarily, or they don't necessarily want to do that because they don't have the regulatory environment to support that as well.
Absolutely. Right? Their sentiment is, this is great. Let's enjoy it. Let's pass the dividends along to our shareholders. But
instead of reinvesting,
commitment of capital to future exploration, no.
Mm-hmm.
Thanks to government, that's not happening. So supply demand has been interrupted in a way that a market would not be interrupted. But we don't have market forces here. We have government regulatory forces. And in Europe, it's even worse because they've shut down so much of this stuff that they try to restart it again. It's going to take a year or two.
Mm-hmm.
Nuclear plants, all the plants that generate electricity, natural gas, so forth. So, they've created their own problem. It's not just a commodity problem; it's actually a policy problem.
Yeah.
And you're right. I think there's not really good incentive for these guys that produce this stuff to expand production. Mm-hmm. They don't trust it.
Excellent, Michael. Well, did you want to go over any of the other charts, or is that? I think that's probably a pretty good place to wrap up today's conversation.
Pretty good. Think so. Yes.
Excellent. Well, as always, I really appreciate your time and being so generous with the charts. Of course, this was just a taste of the amount of charts and information that you put out on your service every month. And
actually, we have like 5-6 reports a week, but that commodity report is monthly. Yes, you're correct. Yeah.
Well, that's what I mean. There's just a constant stream of excellent analysis and all of the notes along with the charts. And the momentum chart is something that you can't really get anywhere else, right?
Well, some people do momentum. There's a lot of MACDs and RSIs and stuff like that, but they're not really structural. They're more like wet noodle indicators. But we look for structure, something that would, just like a price chart. Mm-hmm. Analyst would look at a ceiling or a floor or a well-developed trend line. Something when you break it is likely to make a noise, mm-hmm. And it create new direction. So we like something that isn't slovenly, but it's snap effect. And that's what momentum tends to give us.
Excellent. And of course, your guys' website, olivermsa.com and at Oliver_MSA on Twitter. Michael, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.